Time is like tossing a coin. Time is either working for you or it's working against you.
The rich don't get rich from saving. You can only get rich, or wealthy rather, from saving to invest. So
if you're holding cash at the bank, you're picking up very little interest, and your real return on that cash after inflation and taxes is next to nothing. But nonetheless, this is where you will be putting your money to become your growth asset. If you ever redeem it, it's going to be worth substantially more for you. Education is not expensive, ignorance is. And just diving into something, hoping it's going to work, is not a smart way to go. We're in a heavy tax country here. Anything and everything that you can do to operate with a high level of efficiency from your tax optimization perspective has to be something that you do. Even at the most basic level of covering your bills, getting your emergency fund, and starting to build some of those good financial habits, now time's working for you. But the longer you leave it, the more you put off getting actually started because it's not the right moment for you, you've lost that and you can never, ever. Hey guys, welcome to this week's Money and Investing Show. Quick question for you. Do you know what the 3 critical buckets are in your wealth journey? I'll give you the first 2. Number 1, liquidity. Number 2, growth. And I'll keep the third to cover in the show. Hop on in right now. As always, don't just take notes. Make sure you take action. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Laurential.
Good to be here, Mr. B. Thanks very much for having me. Now, diving straight into today's episode. Structuring like the wealthy is a question we often get from a lot of our clients, particularly the newbies and a lot of probably the younger generation that we have come through our environment. How do you structure your money insofar as short-term, medium-term, long-term? Where do those buckets then sit? So I guess the topic for today is the 3 buckets of money.
Okay. And this is something you can pick up at any age, depending on where you're starting 100%. The journey. You often think this is sort of level 1, but it really is wherever you start the money. And I guess you could group those buckets into 3 things. 1 is liquidity, having access to your funds.
Short term.
Second one is growth. And the third one is legacy, the longer term kind of game plan. And if we can use those as sort of subheadings, I suppose that'll enable us to work with a bit of structure here.
And I think the further you get along the journey and the ideally wealthier that you get, probably the further along those buckets you're going to get. I think most people probably start in the liquidity space, building up cash flow, but then probably someone in your situation, for example, down the line, I mean, you're probably looking after your kids and your kids' kids, for example, right now, right?
Yeah, well, I look at the cash burn rate in my house. I think I used this line at the event I had last week. It's like a tech startup when I look at my house in terms of cash burn rate. So liquidity is still important. So let's start with that liquidity. What are we talking about here? And I guess the goal of this is it's stuff that's short term. You've got immediate access or call to that funding if you need it. And a good example is obviously cash at the bank.
Yep.
And there are 2 ways of looking at cash at the bank. You can look at it as being an asset, which is a very marginal definition insofar as your real return on that cash after inflation and taxes is next to nothing, but nonetheless it is an asset to an extent. But perhaps more importantly is the utility of that cash too. And I guess what we're driving at there is that need to have an emergency fund and cash on call for bills, groceries, and all the bits and pieces that come along in life. So that's your budget for running your household effectively at its rawest level, making sure your rent/mortgage, utilities, food, fuel for the car insurance, car payments, all that sort of jazz are all sort of handled at that very, very first point of contact. But taking that into a slightly different level of utility, it's something obviously we talk about in the Wealth Playbook, is this notion of having an emergency fund.
Yeah.
So what happens if there's a pause button or a full stop put at the end of your income for a period of time? How do you get by? And we advocate, initially 1 month of emergency fund, which is all of your core bills and necessities. And then once you've built the habit, and that might be something we return to, are the habits once you've got this thing rolling, that you don't go, I'm good with money now, I don't need to worry about that. It's always going to be something that you need to have under control, top of mind. And that is to build that emergency fund out to about 3 months, which really gives you a little bit of breathing space if the unthinkable happens. And I think that's something that's extremely important.
Yeah, I'm going to put a personal spin on this to help our listeners. I like to call my emergency fund almost like my short-term super, where if I ever...
I like that. No, that's a nice term. That's a good way to look at it.
Short-term super. If anything was to stop, let's say place was to burn down here, I was to lose my legs or my hands or my brain or whatever it might be, and I needed to access money.
If you lost your brain...
My brain.
Can you remember the bank code or your PIN number to get you...
I kind of thought about it. I thought... If people listening to this say, if you lost your hands, you'd probably still be able to do your job because, I push pens for a living. So my brain's probably my most valuable asset when it comes to work.
Matter of perspective.
Yeah. So let's just say I lost my brain, right? And I wasn't able to perform the tasks that I normally do day to day. The short-term super, or which is the term I use for this, is okay, that is money that pays for all of my living expenses. To add to your point before, the rich don't get rich from saving. You can only get rich, or wealthy rather, from saving to invest. So I like to, as a piece of advice for all our listeners out there, my working account, which is where all my bills and whatnot, I basically keep only what I possibly need for the month in my working account. Everything else beyond the short-term super, i.e. emergency fund 101, and the working account for bills that month, everything else gets invested.
Right. And you're in then, I guess, if you're holding cash at the bank, you're picking up very little interest these days anyway, but particularly if it's not on a term deposit of some description. So you said 3 months term deposit is your long-term super. And it's interesting you talk about that notion of if something were to happen. And this, whilst it's outside of our syllabus to talk about today, is where risk insurance really comes in. Things like total permanent disability or income protection policies, so that in your instance, if you were to lose a leg or lose a hand
or a brain for that matter,
we'll get to that because that's I'm still trying to fathom that out. It's a very, very quirky description. You got me on the back foot with that. But if you were able to still work but not in your chosen role, that's how income protection can kind of work. You're able to work but just not in your chosen profession versus income protection or TPD across any kind of work, which I guess losing your brain would probably constitute in most instances.
Yeah, particularly if let's say you're a small business owner as well, or a subcontractor.
Let's say eyesight, losing an eye as opposed to brain, because it's not terminal, but probably just as debilitating in your line of work where you've got to look at charts.
That's it. I can't look at charts if I don't have eyes. And if you're a small business owner, I think, as I say, or a subcontractor, whatever it might be in that structure, where you might not have employee income protection, having cash stored away makes you impervious to anything.
So it's you go to, and you're right, try and keep that to a level where you're not tying up excess amounts of liquidity that you could be putting into other things. So an example of other things that you could be doing, with that sort of shorter term liquidity type thing, is if you do have surplus cash, the big decision is, do you start investing it, which is obviously our lane and what we would highly encourage, or do you keep it in an offset account, which, again, makes a lot of sense. It's reasonably tax efficient. It reduces your monthly payments on your mortgage if you've got a mortgage, but interest rates are coming down. And if you think about what the cost of servicing a mortgage might be from an interest perspective, and let's just say, arbitrarily, it's 6%. If you're able to invest that at more than 6%, your cash would be better being deployed on the other side of the ledger. So it's that asset allocation decision there. But, keeping your working account, as you like to put it, in a situation where it covers your bills, you top it up each month from your payroll account, I'm assuming.
Yep.
You've got your monthly or 3 months worth of emergency fund, and that's really the short-term kind of thing. A lot of people would argue that I can put some short-term investing. Let's say you do some CFDs or a bit of crypto or something in that sort of nature that perhaps is a little bit more aggressive. And you say, well, I've got ready access to that money if I need it. And whilst you may have ready access to that money, you might not want to sell it at the price that it's actually trading at that particular level, which means then it's not as ready access as you'd like without taking a bit of a bath on it. So I think we've got to talk about liquidity is cash and cash equivalent type stuff that you can get back immediately.
I'll add one more suggestion to the liquidity bucket, the short-term bucket. I always recommend to have like a travel or a leisure type account. So something that you regularly contribute to, where if you want to go somewhere or you want something in the short term, it's not in your working account. It's in a separate account where you can draw on that cash to be able to buy flights to visit a relative.
I guess you could almost, if you've got a series of bank accounts, which, the people that teach the 5 buckets, and you've got to have all these, obviously there's an account holding fee typically with the bank when you have lots of accounts. But if you've got a special purpose vehicle, so to speak, which is if you've got a purchase coming up, whether it's a holiday or say you're looking to renovate the bathroom in your house or something like that, that is the special purpose vehicle where X amount goes in every week to start accumulating the funds that are needed to do that. Not put on your credit card and then paying the bloody thing off over the next 3-6 months. You've got to be able to put that cash aside. And if you can't find the money to put aside for that holiday to be able to pay for it outright and you think I'll put it on the credit card, you probably shouldn't be taking the holiday. It's as simple as that.
100%.
And you could argue that still pay for it on your credit card. Why? You quite possibly get travel insurance. You quite possibly get points. You're also giving yourself 45 days interest-free credit. But you've got to have the cash there to pay that in full when that credit card bill comes in. And that's extremely important to understand. Don't be going on the never to pay for a lifestyle purchase or a property rent. You've got to be able to pay for it.
100%. I think that deals with our short-term bucket, our liquidity bucket, which is where most people need to start. So emergency fund, working account, maybe special purpose vehicle as such for something that you might want. Let's get to the medium-term bucket, which is the growth bucket. What immediately springs to my mind, AB, would be investments like stocks, property, cryptocurrency, anything of that nature.
Absolutely right. So this is where you will be putting your money to become your growth asset. So the idea is that whatever you put in at the point in time when you redeem it, if you ever redeem it, it's going to be worth substantially more for you. And this is the foundation, I guess, step into the world of getting your finances moving forward. I guess when you look at property, for example, is it an investment property or is it your primary place of residence? And most Australians these days treat their primary place of residence as an investment asset in any case, given how strong our property market has kind of been. So you could argue that could be tucked in there too. But yep, you're right. So your investment property, if you have one, your stock market portfolio, a managed fund, if you've elected to get on that pathway, an area I really do discourage people from doing. I think you're better off being in an index ETF than going down the managed fund pathway. And the other assets that you've talked of, like crypto and so on, are all in there. And the time, why are we putting these in the medium paced place? Well, the time horizon is quite different. You're not putting money into an investment property or a portfolio or an index tracker in the stock market for 2 months, because these are longer term growth assets, which when time starts to work for you effectively, then start to grow. I'm just doing transaction in Brisbane at the moment, and I've done my sort of due diligence on it, and I've just looked at the sales history of this particular property over the last sort of 15, 20 years. And you've got those flat spots where someone bought it in sort of, say, just to pick a number, 2010, and sold it in 2015 and maybe made 10%. And then from 2017, 2018 to 2020, it's doubled. Yeah. And so you've got to be either exceptionally lucky, and I do use that term luck, to be able to predict a market like that, or you simply expose yourself to the market and you're in there through the good and the not so good times, and you're holding that asset over that medium time frame in order for it to eventually move for you. It's not a trading asset, which I guess is the key thing to really identify. Now, if it's a stock market portfolio, that doesn't mean to say you buy a share and hold it forever. You might be more actively maneuvering through that portfolio to get it working harder. Options trading, for example, is a very good example of that. But it still is that medium-term bucket where you're having that time exposed to the market to work for you.
Yeah, I think comparatively speaking, bucket number one, the liquidity bucket, is necessity and security. When we get to bucket two, which is where we are now, it's deliberately exposing the money that you've saved to risk in order to have a better or a bigger amount of that money later down the track. So,
100%. Choice assets, you could call them in a way, because you're actually choosing to do that rather than having to do it.
Now, my question to you then, AB, is let's say you're in a fortunate position where you do have surplus cash. You've then got to choose between stocks or property or crypto. I mean, there's a bunch of different assets out there to choose from. Where would you suggest going for number one, or B, going for advice?
I think getting educated as to what you can be doing in the first instance is crucial, and what you choose to see as value for your education will vary from person to person. If you're someone that doesn't place a huge dollar value on education, I would highly recommend buying our book. It's $30. It's your lowest point of entry. Even following podcasts like this, which is free, is giving you some level of information, but that's where you start to go into more the tactics and the granular detail. $30. Alternatively, if you're going to do something that is a more serious endeavor, and it's not about one investment, it's where it's going to take you over the lifetime, then the courses that we run on the stock market in particular provide a really good platform. And the justification for that, sure, there's a front end cost, but this is a life skill that you're going to carry over the next 20, 30, 40 years. And if you learn the skill properly, it will pay for itself on a compounded basis multiple times over. So, education is not expensive, ignorance is. And just diving into something, hoping it's going to work, is not a smart way to go. To, I guess, the second part of that question, Where do you start? Look, getting started in the property market, obviously there's a requirement for a deposit. As an investor, it's going to be 20% of the value of the property. Given the median property in Australia is about $1 million, should I say? That's 200 grand you got to find, which is an enormous stretch for most people. So primary place of residence, particularly as a consequence of the somewhat negligent and ridiculous, reckless government scheme now for first home buyers. I managed to get all that in one sentence.
Nice one, yeah.
Has lowered the bar and made it, on paper at least, easier for people to get into the market, but they're saddling themselves obviously with significantly more debt in order to do that, and a less demonstrable track record of financial management. So to me, and it was my pathway into my world of investing, the stock market was my first port of call, because there really is no barrier to entry in terms of how much money you need. You can get started with a very small amount, and if you look at some of the sites these days that enable you to save the change from your coffee, for example, like Raise, where you can start to accumulate some investments just with literally the pocket change, which certainly adds up over a period of time, is a very, very low friction, low barrier to entry. And starting to get your money growing in that way makes sense. And we've been on an absolute tear in the stock market. I mean, if we look at the NASDAQ, that's up, best part of, 50-60% now, I think.
Yeah, around 50% as at the time of this recording.
Which is astonishing. But that growth is giving you the ability to get closer to accumulating a deposit for a property.
Yeah, 100%.
So that's probably the pathway I'm taking, and there'll be other people that will have a different view on this, and theirs might be more down the crypto pathway, or even gold for that matter, which has been on a tear as well. Gold doesn't create a yield, so that is a downside to it. There's no ability to create income in there, but nonetheless, there are also two asset classes that have performed pretty well. Ultimately, find your lane, find the thing that's most comfortable for you, and get started.
Yep. You have to be invested. You're likely going to have some debt if it's in the property space, and you're deliberately exposing your funds to risk. I think that's
you can't save your way to wealth. You have to get started.
All right. Let's get to the third bucket now. This one's quite interesting. You're probably the most qualified out of the two of us to talk to this, because this is the long-term or the legacy bucket. What does that mean specifically for our listeners?
Look, I think the time frame and the type of asset and the outcome from those assets are really quite different from everything else, insofar as your day-to-day isn't something you necessarily have to think about anymore. And I don't mean that in an arrogant way, but it's handled, and you've demonstrated, I suppose the term would be, the fiscal responsibility to manage your budget in your house, to be able to save, to get some investing happening, which has enabled you to then grow your asset base. And those longer term assets typically, are going to be superannuation here in Australia. And again, that's a hot button for a lot of people, because we've seen the government sharks circling around. Are we going to tax it? Aren't we? Et cetera, et cetera. And that unsettles a lot of people as to that asset class, which is, something that affects certain types of super, particularly the very, very high balance type superannuations, as opposed to your typical mum and dad. But superannuation, as it stands, is a very tax effective vehicle. Even though you get taxed on the way in, during, and on the way out, is still, relatively speaking, quite an attractive tax structure. It's also, from an asset protection perspective, also a very good structure too, in that those assets are deemed typically just out of reach from things like creditors, for example. So that's something to bear in mind there. The second aspect is outside of super, and that might be where you're building up a longer term property portfolio, and that might be in the commercial space. It could be just simply residential property, where you've got assets that are held that just are at a position now where there's significant amounts of equity that's been built up in them, because they've been held for a period of time, and that appreciation in the market has enabled there to be equity. And in the younger growth phase, you'd probably strip that equity out and use it to fund another purchase, to give you a broader footprint in the market, to ultimately grow over time. But I guess as you get older, to retire, you effectively have to retire debt, as our good friend Torp Stolp, the conversation we had with Torp down in Adelaide that time.
Good quote, that one.
And so, that notion of stripping equity out, it's actually the other way around. You're letting the equity build up to the point where the properties are then unencumbered, and they're spinning out that income to either provide for retirement, or, if you've really built up your structuring in the right way, it might be going into a family trust, and you can start then distributing that income off to beneficiaries of that trust, which, in my instance, I've got 6 children, and then there's my wife and I. And as we get older, the income from our trust will enable us to fund our kids through uni, or also, and it's not going to win us a lot of friends when I say this, from a tax optimization perspective, if I've got 6 kids and they're all at uni and they're not working, well, there's 6 lots of tax-free threshold that we can absorb by distributing the trust into those kids.
If it's within the rule book, it should be done. My parents did the same thing.
Yeah, and that's just playing the game smart. You got to know what the rules are, of course, to do that. Get advice, and there'll be people, and that will make their hackles rise. It should make mine rise, because my father worked in a car factory, my mum was a cleaner, and they had to pay full freight for me through uni. Well, my multi-millionaire girlfriend at the time, her father my girlfriend had a fully funded trip through uni because the dad had got his structuring done. So I guess I'm in a position where I've moved further through that food chain and learnt those rules, and they are what they are. And that's what we can all do, is learn what the rules are and play to them, because that's also a great way of being able to build your wealth by understanding what you're doing and the reasons you're doing it. So, building that long-term asset up in that space. Look, it could be a property of shares, if you a portfolio of shares. So if you take, for example, someone that's had. I had a conversation with someone a number of weeks ago. I was doing some camp drafting with my daughter, and one of the farmers that was there were chatting away. He asked me what my view was on BHP, and he said a dividend reinvestment plan on BHP. Since he bought them when he was a young bloke, and he's well into his 70s, Phil, now. Great guy too, I might add. And so for him, he's built up quite a substantial portfolio of BHP shares. And so what do you then do with those? What's the tax implication of that? And so if they're held in the right kind of entity where you can manage those sort of factors out, makes a big difference. So property, getting the debt down and having it so it becomes cash flow positive. Commercial property, same thing. It becomes a legacy, because within a trust structure, you've got the ability to change the beneficiaries and the trustees and the appointee and or the appointer and everything else that goes around all of that. So it can become quite a good sort of asset protection vehicle. And that's really the long-term game. But none of that happens unless you get rule number 1, start saving, don't spend as much as you earn, get your liquidity sorted out. None of that longer-term stuff really happens.
100%. One thing that jumps out at me, AB, listening to this, and as someone as an outsider who's maybe not at that bucket or at that stage yet, is this sounds quite complicated between structuring different entities, other parties involved. Is that a point in time where you need to speak to an advisor to get this advice?
100%. So I think when you're at the liquidity stage, it's just about getting going and getting the bare essentials kind of done. As you start to move into that growth phase, enlisting some help, as you have, to get professional advice on getting your structure started at day one. And the reason why that's so important, if you were to engage in a property transaction, for example, and it's in the wrong structure, and later on you've got to move it, well, you've got to pay stamp duty on that, which is likely to be a fairly considerable amount of money. You've already paid stamp duty to buy it, but if you're moving it to a different entity, you've got to go again. So getting that advice, whilst it might seem a little bit expensive initially, has got the capacity to save you a lot of money down the line. So definitely get good advice. There's lots of advice out there, but get good advice. We can obviously assist you with a Rolodex, if you will, of contacts and trusted advisors that we use to help us and help our clients go down that pathway. But you've got to get that structuring right. And again, from a tax perspective, we're in a heavy tax country here in Australia, and I can't see it getting any lighter under the present regime. And so anything and everything that you can do to operate with a higher level of efficiency from your tax optimization perspective has to be something that you do. And I think, you'd be a fool not to. I think it was Kerry Packer that said you shouldn't pay more than a cent more than what you legally are obligated to do. And that's not being miserly or playing the game. It's just being smart, because the government do a pretty good job of wasting them.
That's it. I think that pretty much covers us for today, AB. 3 buckets: liquidity, growth, and legacy. Yeah, we've covered most things.
I think we have. And what I probably would reiterate more than anything out of this conversation, if some of it's confusing or you're not 100% sure, whatever it may be, just get started.
Yeah.
The key thing is to get started, because once you're in the game, you can do things. But if you stay on the sideline waiting for the perfect storm, or you've been going through Investopedia to try and learn all of these terms and one day I'll understand how the game, that time is gone. And as I'm fond of saying, time is like tossing a coin. When you toss a coin, it's going to be heads or tails. It's a binary outcome. That's all it can be. And in just the same way, time is either working for you or it's working against you. If you get started, even at the most basic level of covering your bills, getting your emergency fund, and starting to build some of those good financial habits, now time's working for you. But the longer you leave it, the more you put off getting actually started, because it's not quite the right moment for you. You won't get that time back in that year, 2 years, 5 years, 10 years of compounded growth where you were messing around waiting to get started. You've lost that, and you can never, ever catch it up.
Great way to finish. Thanks very much, AB.
Pleasure, anytime. There you have it, guys. Like, comment, subscribe. Most importantly, hit the notification button, and we'll look forward to hosting you next week.